JEPI crushed SCHI with 58% returns versus just 5%. That's a massive 53 percentage point wealth gap. JEPI's 35% gain sounds decent until you see SCHI doubled it at 19%. That gap compounds brutally over time. SCHI's 10% crushes JEPI's 7% over the trailing year. Recent winners don't always stay on top. JEPI dominated the 5-year race, finishing 10 times faster than SCHI. But in the most recent lap, SCHI overtook it. Momentum's shifting. JEPI's positive Sharpe ratio shows it rewarded risk, while SCHI's negative ratio means investors lost money per risk unit. JEPI's strong 0.07 Sharpe ratio nearly doubles SCHI's 0.4, showing much better risk-adjusted returns here. SCHI's Sortino ratio crushes JEPI's. Better downside protection means you're losing less when markets drop hard. Think of this like grading students. JEPI's been the honor roll kid for 5 years, but SCHI just aced its downside protection exam. SCHI's 7% drop looks mild compared to JEPI's 13% crash. That's literally half the pain during downturns. SCHI recovered in just 43 days, while JEPI took 136, 3 times faster back to break even. SCHI stayed shallow at 7%, barely getting wet. JEPI dove straight to 13% and struggled to surface. That's nearly double the pain during downturns. JEPI crushes SCHI on income. 8% versus 5% means you're collecting 60% more cash every single year. SCHI's dividends grew 30%. While JEPI's declined, one income stream expands, the other contracts over 3 years. JEPI crushes SCHI on returns with 58% over 5 years, but you're riding deeper 13% drawdowns versus SCHI's safer 7% decline. JEPI's 8% yield sounds tempting now, but SCHI's dividends grow 30% annually, while JEPI's actually shrink, like leaves getting bigger versus smaller each season. JEPI tracks the market closely at 0.9 correlation, while SCHI's 0.3 means it moves more independently. That 0.3 correlation explains why SCHI protected your downside so well, even while sacrificing some upside gains. JEPI's a near-perfect dance partner with the market at 0.9 correlation, while SCHI at 0.3, it's practically freestyle dancing on its own stage. SCHI spreads risk across 2,300 companies, while JEPI concentrates in just 110, completely opposite diversification philosophies here. JEPI's 110 stocks create concentration risk, while SCHI's 2,324 holdings spread your eggs across thousands of baskets. JEPI concentrates bets across just 110 stocks, while SCHI spreads your eggs into 2,324 baskets. Talk about diversification versus focus. The cost difference is tiny, just $5 per 10,000 invested, so fees won't decide this battle. A tiny 0.05% fee difference can't explain a massive 53-point return gap. Strategy matters way more than cost. Fees are nearly identical here, so think of it like couch change. It won't make or break you. Performance comes from holdings, not costs. JEPI's commanding $43 billion versus SCHI's $10 billion shows investors clearly favor that income-focused strategy here. JEPI wins if you're chasing income today, while SCHI wins if you're building wealth that lasts. So which fund's right for you? JEPI for long-term growth, SCHI if you're protecting capital short-term. Here's your choice. JEPI's the marathon runner building wealth over time, while SCHI's your sprinter protecting what you've already earned near retirement. Standard legal disclaimer: do your research, consult professionals, and invest at your own risk. That's a wrap. Hit subscribe for weekly ETF battles that cut through the noise with real data.